Good afternoon and welcome to our quarterly price index webinar for Q2. Today we'll be looking at how prices have moved in the motor and home insurance markets in the second quarter and the first half of the year. First, a little bit about us at Pearson Ham. Our mission is to help clients improve performance through better pricing, and we work across multiple sectors and can use experience from a broad range of industries to inform innovative pricing approaches. Within insurance pricing, we provide consultancy services in several different areas, so we can help to develop pricing strategies and optimization approaches, taking account of back and front book dynamics, factoring in market and competitor changes. We also provide support in product development and the broader retail proposition, taking account of all the elements which make up the price the customer ultimately pays, not just the core premium. We also help clients become more agile in pricing approaches, including systems, tools, data, analytics, as well as strategy, process, and governance. And one of the other options we have is market pricing insights. And we track daily price movements across motor and home, and that's the data that we'll be looking at today. If you'd like some more information, then please feel free to click on the link, which should be available in the chat. I should have said, if you have any questions throughout the presentation, then please feel free to log them in the chat, and we'll have a brief Q&A session at the end. And I'll go through and attempt to answer any questions that you log. So please just leave those in the chat as we go through the presentation. Okay, so I'm going to look a bit at the methodology, and then we will be looking at motor insurance, home insurance, combined cover and contents only, and then a bit of a look ahead. So what do we expect to see in the market for the rest of the year and going forward. Okay, so in terms of methodology, as I say, we have a market price tracking service. The data we used today comes from that. We have a consumer panel who we use real people and obtain quotations on a daily basis with their real details, real risk profiles, and kind of a genuine customers that are used to make sure that the prices we get back are accurate. We run quotes daily across the large 4 price comparison websites. We've got agreements in place to do this, so we are enabled. And we have a rotation of people, so it's not just the same people all the time, but we'd like to refresh things and keep it as genuine as possible so that the prices that we are tracking are accurate. We also do some data cleansing to remove outliers, and where we suspect that prices may be moving because of something to do with the methodology and approach, then those are removed. So that what we're reporting is genuine price changes from providers rather than anything else that might be causing slight movements in premium. And we have kind of Tableau as our front-end reporting system, which our clients are able to access and view what's happening on a daily basis. So that's where the data's coming from. Let's have a look at how motor insurance prices have moved in the second quarter of the year. Okay, so we've seen motor prices turn following some downwards movement in Q1. This is driven by a kind of recalibration of prices following the initial large increases that we saw in response to the regulatory change relating to fair pricing practices. So there were also several new economy tiered products that have been launched, which have kept the average of the most competitive quoted prices down. So when we're looking at these figures, we're looking at the average of the top 5 quoted prices. So those can be influenced not necessarily by prices going down, but by the average changing if new lower priced product come into the markets. So we have seen some of that. There have been propositions with reduced cover and higher compulsory excess levels, and those have been used to keep prices down in an increasingly competitive market. So demand has dropped. Customers are getting much better and more attractive renewal prices, and conversion is down as well. So new business deals aren't as easy to come by as they were at one point. So we are seeing a drop in demand and also a reduction in conversion rates, which is causing challenges for insurers and is creating this competitive dynamic. However, we are starting to see some price increases coming through now. So as we can see from the chart here, there was a slight reduction in April, leveling out in May, and we've seen some increases in the average of the competitive prices being quoted in June. Looking at it over a 2-year period, so over the past 24 months, most competitive prices in motor are still around 8% lower than they were 2 years ago on a like-for-like basis. So this is using comparable basket of risks. Now this it's been an unprecedented period, obviously, with COVID, followed by the change in regulations, having a massive impact on pricing. But it's difficult to see how such low levels of pricing can be sustainable. At the kind of start of 2020, I had expected that was the start of the cycle turning and prices would start to rise then, but obviously everything has changed since then, but there are still significant pressures on costs, which must start to have an effect soon. Looking back over the past 6 months, prices are still around 7% higher than they were as we moved into 2022, with the increases that we saw flowing through in January. So we've have had some downward movement as insurers adjust to the new competitive landscapes. As I say, that there's been a massive drop in demand, as well as a lot of new lower tier products being launched. So I think we are starting to reach a more stable position in motor. So where we kind of are in May and coming into June with those prices starting to creep up, I think we've reached a bit of stability. Okay, so looking at how individual providers have moved. So this gives us a view of movement by brand, and it's looking at a selection of 10 large brands. So it takes out the impact of any of those new economy products coming in. So this is like-for-like brand movement. And we can see that increases have been fairly consistent across those large brands, and some quite significant increases being reported here over the past 6 months as well. So where prices have reduced, this tends to be where much larger increases were put in ahead of January. So it's a bit of rebalancing. So those two insurers at the end where we're seeing price reductions is a function of recalibration following the FCA regulatory change price movements. Okay, looking at some of those insurers on a monthly basis. So this is the indexed view. So we can see that kind of the trend for the biggest movers has been fairly consistent. So Q1 saw much more kind of volatility as insurers adjusted to the competitive landscape, but it appears that there's more consensus now in kind of prices moving upwards through April, May, and into June. Again, we are seeing kind of relatively consistent trend here over the past 3 months. So the outlier brand movement as I say, has been driven by changes to the product itself. So here we are seeing the introduction of a new brand with the same name, but the kind of a reduced level of cover, and that's what's kept the prices down here. All of the others, we can see that kind of relatively consistent upward movement over the past 3 months. So overall, the story in motor is kind of volatility and some recalibration in Q1, leveling out and turning into price increases as we move through the second quarter of the year. And we'll come back to what that might mean going forwards a bit later on. Okay, so that's motor. What's been happening in home insurance? So we saw bigger movements in home ahead of the regulatory change, and those came in sooner. So what's happened over the past 3 months? So what we've seen in home is the average of the top 5 quoted prices has dropped by almost 4% in the second quarter of the year. And much of this is the result of new market entrants with extremely competitive rates and the introduction of some lower tiered products. So that's impacting on the average of the most competitive prices being quoted. This activity has come slightly later on home than it did in motor, but we are seeing a kind of a similar trend. However, the extent of the price reduction has been decreasing throughout the quarter. So over the past 3 months, we can see that a 2% to a 1.5% to a 0.5% reduction each month. So it looks as though we're coming out of that, and we are following a similar trend to what we're seeing in motor, perhaps a couple of months behind that. Okay, so looking at the past 6 months, so prices that we're seeing here are still around 5% higher than they were at the start of the year. So there was the large increases in January, following on from similar increases in February. So although there's been downward movement since then, we're still around 5% higher than the start of the year. And we've seen an extended period of recalibration following those large increases. And this is, as I say, is probably running a couple of months behind motor, but following a similar pattern. Looking at individual provider movement. So this is, again, a selection of 10 large brands. And over the past 3 months, we are seeing kind of less consistency than we are in motor. So several insurers here have lowered prices, as well as those putting through some very significant increases. So an average would show an overall upward movement from these established brands. So thinking about the impact of new products and lower tiers. So we would see an increase on average for established brands, even if we take out the insurer one outlier on the left. So that highlights the kind of the impact of new providers on the average of the top 5. Looking at some of those movements over the past 6 months, what have they looked like? So a lot of variance between current pricing at the start of the year is driven by the January increases. We're still seeing some individual insurers putting prices up. So we can see here in May quite a large increase coming through. And when we're looking at the other end of the previous chart where prices are lower than they were, this appears to have stabilized over the past couple of months as well. So we can see here reductions being applied in April, which have flattened out into May and June. Looking at contents only. So on contents only, the price movements actually follow a very similar trend to motor. So we've seen some reductions in April, stabilizing in May, and larger increases flowing through in June. So the overall impact of that is prices throughout Q2 have increased by around 1.5% for contents only. So this means an increase of around 10% for the first half of the year. So adjustments following the initial increases at the end of 2021 and the start of this year have now moved into a trend of more consistent price inflation. Looking at individual provider movement, again, a large selection of 10 of the large brands. So most large brands have increased prices for contents only, with a few exceptions. And looking at how that's trended over the past 6 months, we can see where price increases have been deployed. So most providers have started the year with large upward movements, and changes more recently have been from those who didn't increase as much initially. So if we're looking at the index movement from December into January, the larger increases that we've seen have been from providers who waited slightly longer before putting those increases through. And again, we have seen some price reductions recently, and then these have mainly been from insurers who put very large increases in towards the end of last year and the start of this year. So again, we're continuing to see a rebalancing, a bit of recalibration as insurers adjust to the new competitive landscape. Okay, so looking ahead, so what can we expect to see for the rest of the year and perhaps moving into next year? So there's quite a lot of things going on. It's an unprecedented time within the industry for pricing. There are a lot of moving parts, so it makes it challenging to be able to try and predict exactly what's going to happen. But we can look at the different factors that are influencing things and the different trends that we've been observing. So firstly, looking at recent pricing trends. So we have seen, as I say, new economy products reducing levels of cover and higher compulsory excess being used to keep prices low. It's an incredibly competitive market with reduced demand, depleting the new business market by around 20%. However, it feels as though providers have done about all they can to keep prices down, and the cycle appears to be turning now. So we've seen stabilization and price increases over the past couple of months. So the small increases in May and then slightly larger into June, I would expect to continue as we move forward. In home, we're seeing a similar trend, but I think probably 2 months behind where we are in motor. So I would expect when we come back for the Q3 webinar, we will be reporting some increases there. There's the loss ratios, so the profitability within the market. So there has been an ongoing benefit of COVID on customer behavior that has then had a knock-on effect in terms of profitability. And we have seen that in 2021, the kind of loss ratios didn't return to the pre-pandemic levels. So there's still that ongoing benefit. Whiplash reform, I think, has had a greater benefit than may have been expected. Overall, 2021 was a profitable year. We expect to see some deterioration into 2022 because of the rising costs that we're seeing in the market. So moving on to that, claims inflation. So there are ongoing supply chain issues. We've got labor shortages, costs of parts is increasing repair costs. Delays are also lengthening the time replacement vehicles have been needed. So that, again, there's a knock-on cost. And similarly, in home, we're seeing cost of materials increasing, rebuild and repair costs along with them, and delays, again, resulting in additional charges for alternative accommodation and those sorts of other associated costs. So there's a lot going on, and there's a lot of pressure on costs coming from different sources and driven by different reasons. Cost of living. So we're seeing inflation soaring, massive increases in fuel, energy prices, food prices. And at times like this, we do see policies being cancelled. We see additional claims being made where people may not have bothered before. And we do see an increase in fraudulent activity. So all of these factors may kind of, again, will be pushing prices upwards. And thinking about customer behavior. So we have seen, as I say, a drop in demand in the new business market. Much more attractive renewal prices have improved companies' retentions. So there are fewer people out there shopping around at the moment. People may become more likely to shop around in the hope of making savings. So there is a kind of a massive increase in cost of living. So that may stimulate a bit more new business demand as we go through the year. And as we move into 2023, this may be bolstered by year-on-year increases at renewal. So when prices start to be set on the same basis as they were last year, then we might start to see more shopping around. It's just a case of whether the deals will be available to encourage customers to switch. So in summary, we've seen EY's figures this week. So they're predicting a 2% increase in motor premiums this year before an 18% uptick next year. EY is expecting industry level net combined ratios for this year to be at 113.8%. This is comparable to that they had 103% prediction for 2021, which didn't quite materialize, and that came in about 96. So I'm not sure it's going to be quite as bad as being predicted, and I think a lot of that could be mitigated by increasing rates. I think we probably will see inflation ahead of the 2%, the premium inflation ahead of the 2% that they are reporting. So I think given what we've observed recently and the underlying inflationary pressures, I would expect more rapid increases for the rest of this year, becoming a bit more volatile as we move into 2023. I think January can represent a new page in the dual pricing story. So renewal prices having been set on the same basis as last year, but with the added pressure of increasing rates, which may not be constrained as they might previously have been done by capping activities. So where rates are being linked back to what was paid the previous year, then it was easier to manage that. In a combined dual pricing approach, that might not be as possible. Okay, so that's the end of the presentation. So if you do have any questions, then please feel free to log them in the chat. Okay, so do you think we'll see more product development this year? I expect providers will continue to look at what can be done to keep prices low and to compete in a much depleted new business market. I think most of the tiering in motor has probably been done by now, but we're still seeing new online propositions being launched. So I think where there are savings that can be made, that can be passed on to customers, there's an obvious benefit there, and I think people will continue to look for those opportunities. On home, there's probably a little bit more to come. I think, as I say, things are running slightly behind where they are on motor. So both in terms of price movements and product development. So I would expect that there's probably a bit more to do there. What level of price increase do I predict for the rest of the year? So it's a difficult one. I don't think 1% or even 2% a month for the rest of the year would be unrealistic. So from where things are now, somewhere between 5 and 10% increase between now and the end of the year. We've already seen this level of increase from some of the more established brands, and it's a case of the market catching up and that the kind of the average of the top 5, the most competitive rates, catching up there as well. How do you think prices will move next year? As we get into January, I'd expect a bit more volatility. So I think there's some stabilization and some upward movement to be expected this year. I think when we get to January, demand could return to the new business market as those year-on-year price increases are flowing through. So we've got kind of inflation based pricing. So it's likely that the kind of the quotes for renewals are going to be higher than what was paid last year, which is a massive driver of shopping around behavior, and not constrained by capping as they may have done previously. So I think insurers will be keen to take advantage of the new business opportunity there. So I would imagine there will be some more volatility in the market while that happens. Longer term in 2023, I think prices still need to come up. There is that ongoing inflationary pressure, and I think that isn't going to go away even if we do get the level of price increases I'm expecting this year. That I think there is still some way to go to get into a safe and profitable ongoing position in motor and home. Okay, so if you'd like any more information, then please feel free to get in touch with me. There's a link to the guide that we have here on the chat. Please feel free to click on that, or you can contact me directly. My email is stephenkennedy@pearsonham.com, or you can give me a call. So thanks for your time today, and I look forward to seeing you again in the next session in October. So things continue to move, and I shall be looking forward to seeing what happens next. Thank you very much. Bye.